In today's episode of my Investing for Dummies series, we will cover mutual funds. Welcome to Vigilant MD, Lessons Beyond Residency. It is important to note that I am not a financial advisor, and this video is not financial advice. Let's jump right in. A mutual fund is a type of investment that contains a mixture of many stocks, bonds, and/or other assets. Mutual fund companies take the collection of money from investors and buy stocks and bonds and other assets to create a portfolio. When you buy a share of a mutual fund, you buy a small piece of all the stocks, bonds, and assets that are contained within that portfolio. Because a mutual fund usually contains more than 100 securities, buying just one mutual fund can significantly diversify your investments so that all of your eggs are not in the same basket. Here's a quick example. Let's say you buy $10,000 worth of a mutual fund, which contains stocks from 100 different companies. If one of those companies goes belly up, if the other 99 companies are doing fine, you will lose just a fraction of your $10,000 investment. But let's say you bought $10,000 worth of stocks in just two companies, meaning $5,000 of stocks in each company. If one of them goes belly up, you are going to be down $5,000 or 50% of your investment. Clearly, the diversification provided by the mutual fund decreases the risk that the investor will lose everything if one or two companies don't perform well. Because mutual funds naturally provide some diversification, they are the most commonly offered assets in retirement plans. Next, let's break down some terminology. The price of a share of a mutual fund is called the net asset value per share, or NAV. When you want to buy or sell a mutual fund, you will buy them at the current NAV. The NAV of a mutual fund does not fluctuate during market hours, which is between 9:30 a.m. and 4 p.m. Eastern Time on weekdays. A new NAV will be determined at the end of each trading day. So let's say you buy a mutual fund which contains stocks and bonds. The income that is earned from those dividends on stocks and interest on bonds within the mutual fund will be paid out to shareholders as a distribution. Investors can choose to get paid a distribution as a check or reinvest those distributions to buy more shares. Now, this might sound a little bit confusing, but a mutual fund is both an investment and a company. The CEO of a mutual fund is called the fund manager. Let's talk about fees involved with mutual funds. Because mutual funds are professionally managed by a company, they will charge annual fees as a percentage of the funds that are under management, called expense ratios. The lower the expense ratio, the lower the fees. Mutual funds also charge sales charges or commissions, and these fees are collectively called the load. The load is paid by the investor when they are buying and selling a mutual fund. A front-ended load means the investor pays the fees when they buy the fund. Back-end load means the fees are charged when the investor sells his shares. Okay, what are the different types of mutual funds? Mutual funds can be divided into several types according to the assets that they contain within it. Number one, equity funds. These mutual funds are composed of mainly stocks. An equity fund can be described by the stocks that are in it by what is known as an equity style box. So if you refer to this diagram, the vertical column shows the size of the companies the fund contains according to their market cap. Once again, small cap is between $300 million to $2 billion. Medium cap is $2 billion to $10 billion. and large cap is over $10 million. The horizontal column shows whether the companies in the fund are value stocks, growth stocks, or blend. Value stocks represent high-quality, low-growth companies that pay dividends. Growth stocks represent companies which are trying to rapidly grow and do not pay dividends. Blend stocks are companies that are neither value or growth stocks and are somewhere in between. In this example, the mutual fund would be composed of large-cap growth companies which won't pay any dividends. The second type of mutual funds are fixed income funds. These mutual funds are primarily composed of government bonds, corporate bonds, or other debt instruments. Number 3, balanced funds. These mutual funds contain a hybrid of assets such as stocks, bonds, money market funds, or other investments. Number 4, index funds. These mutual funds contain stocks that mirror major market indices such as the S&P 500, Dow Jones Industrial Average, and the NASDAQ Composite Index. The fund managers simply balance their stocks to look similar to the hypothetical index, and therefore they don't really have to do as much research and work on their own. So they charge lower expense ratios. I will go into more detail regarding index funds in a future video, so stay tuned. Number 5, money market funds. These mutual funds are composed of money markets, which are extremely safe short-term debt instruments like treasury bills. Although this is very safe, your returns are going to be very, very low. Number 6, income funds. These mutual funds invest in a variety of bonds and hold them to maturity to provide steady interest income. The cash flow from these funds will produce regular income, and it'll be taxed as regular income. The cash flow from these funds will produce regular, dependable income, so it is a popular choice of people who are retired. Number 7, last but not least, exchange-traded funds or ETFs. These are very similar to mutual funds, but they are structured in a way that they can be traded on stock exchanges like they are stocks. While mutual fund transactions are settled at the end of the market close just once a day, ETFs can be bought and sold at any point during the day like stocks at differing prices. Also, ETFs tend to have overall lower fees and some tax advantages over mutual funds. There will be a separate video on ETFs in the future, so stay tuned. Okay, I know that was a lot. Thank you so much for continuing to watch my Investing for Dummies series on mutual funds. If you enjoyed this video, please give this video a like and subscribe to my YouTube channel and turn on the notification bell so you don't miss my future educational videos. See you guys next time.